and we'll go into discussions. So today on our panel, we have Meswell Wuneli, Managing Partner, Sahel Capital. We have Megan Curran, West Africa Director for Acumen. We have Maria Glover, Projects Lead, Impact Investors Foundation. You're all very welcome. And my name is Lolade Aogbadi, and I work with the Development Bank of Nigeria. Today, we're talking about access to finance, pathways for social enterprises. Funding MSMEs is a discussion that I'm quite used to, as are all of you. However, today we're talking about MSMEs with a social impact lens and how best they can get the funding that they need to successfully run their businesses. And so today's discussion, we will try and make as easy to understand for our wide audience as possible, but also success for us on this panel is for everyone to walk away knowing what to do if they're MSMEs looking for sources of funding, alternative sources of funding, or even maybe how to better structure internally their businesses. And so without saying too much more, I just want to talk a little bit though, before I ask the first question, just to sort of set the tone about the world of MSMEs and how successful they are in accessing finance. Today in Nigeria, we see that MSMEs contribute more than 50% to our nominal GDP as a country, and they employ 84% of labor in the markets today. However, MSMEs are also recipients of less than 5% of all credits granted by commercial, traditional financiers, so our commercial banks. Now, I'm hoping that from our discussion today, we can open up conversations for alternative sources. So what are some of the ways MSMEs, social entrepreneurs can access finance? And I'm going to kick off our discussions today with Maria. Now, Maria, based on your work at the Impact Investors Foundation, you have a lens on the Nigerian social impact investment ecosystem. You also have quite an extensive relationship, your organization, with organizations like the Global Impact Investment World. So in helping to set the tone for our discussions today, please talk us through what the social impact investment scene in Nigeria is like today. Who are the major investors? Who are the operators? What are some successful cases that we've seen? One or two.
Thank you very much for that. The social impact investment, simply impact investment, is growing steadily in Nigeria and gaining reputation and awareness among investors. The community is more embracing it, using it either as an asset class or investment strategy to screen their investments. In the study that IIF commissioned last year to look at the landscape for Nigeria and Ghana, which is a build-up to the one that was done in 2015 by the Global Impact Investing Network, really produced some very interesting findings. It shows that the capital deployed for impact investing had increased significantly. As at 2020 September last year, the figure stood at $4.7 billion US, which represents a 147% increase from 2015, which stood at $1.9 billion US. And the space is dominated by development finance institutions, deploying over 80% of impact capital. And interestingly, the DFIs can have a favor for debt instruments over equity. And the average ticket size being deployed is about, in Nigeria, over $60 million per transaction. In terms of sectors that the DFIs are investing, the top three are agriculture, public sector, and infrastructure, owing to the fact that these sectors can absorb the large size tickets. On the non-DFI sides, which is dominated by foundations, fund managers, institutional investors, like commercial banks, they're deploying about 20% size of 20% of the capital, and the ticket sizes are usually smaller size. An average size is about $2.6 million. Looking specifically at the challenges within the ecosystem, on the demand side, there's a limited pool of investment-ready businesses that reduces the overall investment opportunities in the ecosystem. The report also disclosed that there's a high failure rate of early stage businesses as a lack of access to early stage financing, which makes it really risky for investors to invest in early stage businesses in Nigeria. On the supply side, there's a limited supply of suitable capital that meets the demand of the market. And the ecosystem really was really weak in terms of providing the kind of support to enterprises to move from startup to receive the right kind of capital to scale. So there's that weak intermediary part of the ecosystem. Now, looking at some successful recipients of impact capital, there are several recipients of impact capital, from MSMEs to social enterprises to even government and fund managers. I'll just mention one or two. Recently, I think in January, there's a new startup called Okra, they're a fintech company that raised 1 million pre-seed funding from TL Capital, and that was their first investment in fintech. There are so many others: 54 Gene, Paga, Ideas, 54 Ideas, and so many other enterprises and fund managers who are receiving impact capital within the space.
Thank you so much, Maria. And I'm very excited that you mentioned the phrase impact ready, investment ready enterprises. And we're going to talk a little bit more about what that means, because I think that's also like a huge part of what the conversation should be before we even talk funding. But next, Mezo, I want to come to you. So in 2019, Sahel Capital won the Impact Investment Award of the Year. And that tells us that you are familiar with the ecosystem and you're quite active as well, the organization, Sahel, that is. Now, if you could give us a cheat sheet for why or how Sahel sort of makes decisions in terms of what companies to invest in. I know that there's a strong commercial element to how you make those decisions, but could you just tell us, give us some tips of what you sort of look out for before you make key investment decisions?
Sure, thank you. I think, first of all, we were very honored to be selected last year and appreciative. And, I think on the spectrum of impact capital, where you have philanthropic investment on one side and then more commercial minded investments on the other side, as you mentioned, we're more commercially focused. Now, given the sector we're in, we also are very focused on the impact we have, into smallholder farmers. So we will not do a deal unless there is a smallholder farmer element tied to that. Now, I'll talk about what we look for, and then also talk a little bit about what would make us not do the transaction. So from a high-level perspective, we're, top down, which sectors are exciting to us, have some interest. And the number of different things that drive that dynamic, but it's tied to where we believe that there can be value creation. We look at food scarcity related issues, where can investments we make address food scarcity. We look at import substitution, where can we make investments into companies that have an import substitution leaning, especially when over a period of time they can build a competitive advantage regardless of import tariffs. We look at middle-class growth, especially, population moving into urban centers from rural areas. What kind of investments can we make to address those issues? And we also look at investments we can make to fix structural issues in the ecosystem. So from a big picture perspective, there are a few things we're looking at. Then when we then drill down to individual companies, I think the first thing we look at is really the entrepreneur that is driving this initiative. How passionate are they about the opportunity? Do they know the business? And we're not really necessarily looking for sophistication, but passion and knowledge of sector. We also pay attention to the business case. And in the business case, it's really how can we help the entrepreneur build scale within that particular sector. Given the ticket size where we focus, we do roughly $1 million to $8 million. We do equity, we don't do debt. And so there's a minimum size of company that we look at, roughly 300 million naira odd revenue and above. but we're very attentive to what are the clear pathways to build scale, and can we see that scale being built in partnership with that entrepreneur? And then tied to that, of course, is given we're an equity investor, how do we see in 4 or 5 years that pathway to exit, so we can take the capital back, return money to our investors? Now, separate from this, I'll touch on governance as well, because governance is a very big issue that we're attentive to. And if there is one thing that would probably cause us not to proceed with investment are governance related issues. And within governance, it's stuff like statutory compliance. Is there commingling, no commingling of funds? What kind of processes and controls are in place? But we don't expect everything to be perfect, but we need to see that there is an interest and attempt to ensure that the entrepreneur is looking to build these structures and put these different things in place as they're looking to build their firms. Now, in terms of so each impact investor has different criteria of what they look at. So if you're a social entrepreneur, looking for capital, I think it's also important to realize that not every naira is the same. So each impact investor has sort of a different focus area, different criteria, and you need to be attentive that that focus area, that criteria matches neatly with your own particular initiative, stage of development you're in, and just to make sure that matching works well is very important. And I'll pause there, and I can come back and go into a bit more depth in some areas.
Absolutely, we'll definitely be circling back to you soon. And I really like the fact that you actually started to go into the next question I had, which I'll direct towards Megan, talking more about what on the inside entrepreneurs need to have in terms of a structure. Now, Megan, Acumen International is a philanthropic venture fund, and you have both a global and a local lens. Now, could you walk us through what a company like Acumen would typically look out for in terms of internal structures? So what should these companies put in place? Already we have Mezio, who's already started talking to us bits about governance. What else should they have, and what are some of the things that Acumen looks out for before making key investment decisions? Are you on mute?
Sorry, thanks so much. Gotcha. Yeah. What's interesting is that even though Mezua and I are focused on slightly different stages of company, Acumen will make investments of $250,000 up $500,000 or $750,000 as a first investment. So we're also often dealing with earlier stage companies, but I think a lot of those core criteria that we're looking for are quite similar. And so we're looking, governance was one of the key points I was also going to mention, where statutory compliance, some basic process and controls. I think we're also really interested in board composition and structure. A lot of times companies that we meet, they may have a more informal board that's made up of friends and family or some early investors, early individual investors. And we really want to start that conversation with them of formalizing some of the reporting mechanisms with the board and some of the decision making, bringing in subject matter experts or sector experts so that the board becomes a governance function that is adding strategic value to the company, as well as some oversight on these process and controls. We also want to see that the company has an understanding of what it will take to scale, and often that manifests itself in terms of internal structure in some strategic finance capability that not only do they know, how much revenue they're generating and what their expense base is, but on a unit basis, for each additional product that they sell, how much margin or profit are they generating, and how long do they think the path is to reaching break even or reaching profitability. Most of the companies that Acumen invests in are not yet profitable, and ensuring that they have a combination of the team and the vision and the internal reporting function to be able to lay out that path clearly, recognizing that a lot of that will change. Product market fit is not always, none of this is static, but that the capability is there to be able to track the right operational KPIs and financial KPIs to paint the longer term picture.
Fantastic. Thank you so much, Megan. I have a question around COVID, and I'm going to go very quickly, circle back to Mezzo for this. I think in trying to make this discussion as relevant to our present state as possible, I want to talk about how exactly these social enterprises should be thinking to successfully swim through this COVID or post-COVID period and sort of weather the storms. Because we see that a lot of investors are, there are a lot of conversations that are happening right now. People had made projections into what 2020 would look like and possibly even 2021. But a lot of those conversations have changed tact. And what advice would you give entrepreneurs, social impact entrepreneurs today, in order to position themselves to sort of swim and survive it?
Sure. I think there are two parts to that. I think the first is for the social enterprises that already have external funders, partners, or investors. I think it's important, that there's transparency in conversations of the issues, the challenges, the performance, where support is needed. And, to the degree you have the right partner, the partner will work with you to help solve those issues. And, it's really when you go through, difficult challenges that you really find out, whether you have the right partner or not. But, engaging, I'll strongly recommend or encourage that transparency, that engagement, and reaching out for that support and leaning on the partner for that support. Separate from that, I think the other thing that, entrepreneurs should be attentive to is, even though there's a lot going on now that can easily take up your entire emotion, your entire time, is to also focus on investing in yourself and also in your organization. And when I mean investing in yourself, it's not just continuous learning, but taking time out to emotionally recharge, whether it's exercise, which I do, or something else, so that that time out helps think through issues better, especially when going through a time of stress, separate from the continuous learning that you should go through, to help pivot. And then invest in your organization is also, paying attention to that your enterprise also consists of individuals who are also going through their own individual challenges and personal stress and pressure during this time, which may be COVID influence, at the home front, or maybe concern and worry about what's happening to the business. So being attentive to those concerns, and also being attentive to engagements with the broader team to help pivot and reposition for the next stage of the growth. And being very careful to not be overwhelmed with the challenges of today, but to be focused on the next steps and ensuring that you have clarity of mind and support around you to ensure you're able to pivot and take the next steps forward.
Right. Thank you so much. And talking about challenges, Maria, based on your experience, and it always, usually when individuals go through hard times or a business is struggling, the person that's in the moment tends to think this is peculiar to me. And so one of the things I would like to also ask you, Maria, to help us sort of draw a picture of what the current landscape is like, is talking through what some of those challenges might look like today. So for entrepreneurs that are either trying to build or trying to scale, what are some challenges that you've seen that probably happen time and time again? And what's some key advice you would give entrepreneurs in order to get them successfully through that hard bit?
Thank you again. There are a myriad of challenges that social enterprises will face at the macro level, which are challenges that are beyond their control, such as the harsh economic environment that we're facing right now in the country and even across the continent, market failures, policies or the lack of policies, lack of infrastructure that invariably increases the high cost of transaction, which makes the very harsh terrain for social enterprises to survive. And this is one of the reasons why there's a high failure rate of enterprises in Nigeria and in Africa. I will speak to also the fact that accessing early stage finance is going to be and will continue to be a huge problem for social enterprises. So there are various options and sources of impact capital or other forms of capital they can gain access to beyond grants. Grants is fantastic. Grant has the potential to develop markets. It has the potential to sustain early stage enterprises, growth stage enterprises to enter into new phases and so on. So some of capital that social enterprises can gain access to are grants from philanthropic organizations. They can partner with foundations, because foundations normally solve the problems that those enterprises are currently solving. But right now, philanthropic organizations are finding out that they are not providing the kinds of capital in a sustainable way that will solve these social problems. So they are now partnering with social enterprises that are now solving such problems. So this is one way social enterprises can partner with philanthropic organizations. There are angel investors too who can provide non-financial and financial finance for enterprises at early stage. Another challenge I think social enterprises will see or face is their lack of access to the right type of capital and the right mix of capital. Social enterprises, by their very nature, are a unique set of organizations that build impact around their business models and also making profit from it. And in order to kind of make impact, they must scale. And for them to scale, they need finance, and not just any finance. Not all money is good money. They need to be aware about that. They need to find funds that aligns to their vision and to stay focused to what they're trying to achieve. And also, I will speak to something I mentioned more earlier in my conversation, saying that there is a very weak mediation actors that are not providing the right kinds of support to enterprises to receive capital, especially from impact investors who are willing or happy to give larger size tickets from 1 million and above, like Maiswell said. So we need to have support for the intermediary actors, business development services, incubators, hubs, to provide the specialized services for social enterprises to receive trainings, both in impact readiness training and investment readiness training that includes things like governance and other things that investors look out for before they invest in enterprises.
Fantastic. Thanks, Maria. I just glanced at the chat on the side. Somebody has literally just written, God bless you, Maria. You're speaking very practically, so well done. And I like the phrase that I think it was Mezzo who mentioned earlier, that not every Naira is the same. Now, Megan, my next question is to you. How can social entrepreneurs accurately determine the source of financing best suited to their existing business and impact models? I mean, so how do they even begin to identify, look, for the kind of business I run, I should do or I should chase this sort of funding, this sort of investment?
Yeah, this is such an important question, because I think so often we meet entrepreneurs and you say, okay, what type of capital are you looking for? And the temptation is to say, whatever I can get, debt or equity or grants. But we really want to see that the entrepreneurs understand what the best uses of each of these types of capital are, what the different constraints of each of these types of capital are, and what best fits to their own business model. And so I would say, in doing that diagnostic as an entrepreneur, the first question is, what is the capital for? Is it for something that's going to generate value for the company in a very short-term and predictable way, or is it a much longer-term vision? And that, you know, will help you determine. I'll talk a little bit about each of the different types of capital. The second, and maybe I've sort of touched on this already, but how quickly and predictably are you going to be able to generate cash from that capital injection? You know, if you're taking a loan, those principal and interest payments come faster than you think, and you have to have some degree of certainty that you're going to be able to meet that repayment schedule. And so it's a question not only of how quickly you're going to generate value, but also how solid is the business model that you can predict with some regularity those cash flows. And then finally, who do you want to partner with? You know, I think this is especially important in the context of equity, where it's a long-term partnership that comes with decision rights and governance and just a more integrated partnership. As Mezwa said, you don't really know who you're partnering with until the going gets tough, or maybe sometimes that's when we learn the most about who we've partnered with. But I think really understanding not only what your priorities are as a company, but what the priorities and expectations of the investor are, because that's going to influence that relationship a lot throughout the life of the investment. So I think those are the three critical questions. You know, there's a stage component, you know, where grants are more often and better used when you're really right out of the gate. But you don't want to become over-reliant on grants because, one, you're not proving to anybody that you have a sustainable business model. And two, it can become very time-consuming and unpredictable to chase grant capital and can't be relied on to support. You know, it's good to solve a one-time need if you're doing R&D for a specific product or, you know, running some kind of pilot. But you don't want to start to over-rely on that grant capital. And then debt and equity are, you know, the two that I think maybe we're more familiar with, where debt is best used, again, where you have this predictability of cash flows. Maybe it's for working capital, equipment leasing. It can be very tempting because it's not as dilutive in terms of an ownership structure, but you don't want to go for that debt too early on. And then for equity, you know, where you are going to be expected to give up some ownership. And this is, as I said, where we're understanding what's really important to the entrepreneur. But this is good when you're in a stage where you may not have that predictability of cash flows, but are looking for ways to grow the business. And equity can be used to grow the team, expand into new geographies, et cetera. And then just, I finally wanted to mention, you know, the one sort of type of capital that's often overlooked, which is free cash flows from your own business. You know, this is not so easy to get, but, you know, is what enables you to keep some of that owner structure in place and using profits generated to reinvest in the company. And this works especially well for companies that may not have an exponential growth trajectory that they're looking at, but want to grow more incrementally over time. And so just wanted to throw that in the mix as well.
Fantastic. I think that was really useful. I think my next question, I would like to get the viewpoint of really everyone on this panel, because I think it's still, for a lot of social entrepreneurs in general, even for Nigeria, it's a discussion that's currently ongoing. But I do realize that there's potential there for entrepreneurs, and I'm talking about the African Continental Free Trade Agreement. And maybe we could just take it one by one. What are our thoughts? Are there opportunities there? Should social entrepreneurs begin, especially people or organizations in the scale phase of their business, should they have an eye on this? Mezwa, your thoughts?
Sure. So I think it's definitely an opportunity there. It shouldn't necessarily drive your business model, but in the food and ag sector, there are already informal trade flows between Nigeria, Togo, Ghana, and the other way around. Pineapples, coming, one direction, the other, grains, different food products. So there's opportunity there, but for your business model should be built not necessarily because of that, but that can enhance the opportunities as you're growing your business. And so there is potential long-term opportunity there, and a potential threat as well, because you have more competitors coming as well the other direction. So it works both ways.
Right, right. Maria, thoughts?
When he talked about the opportunities too, I was going to say there are also potential threats as well. And social enterprises should do a SWOT analysis to see what are the opportunities and what are the weaknesses I have in my organization, and how can I position myself to take advantage of the free trade, because it comes with a lot of opportunities, access to market, and all of that makes you have a very broad market just beyond Nigeria. So it's good to position yourself, do a SWOT analysis. What are the threats? What are the opportunities? How do I need to position myself to take advantage of this huge, great opportunity? Thank you.
Fantastic. Megan?
Yeah, I mean, I'll put a +1 to each of their contributions. And for the sake of not repeating, just wherein the free trade agreement might also create some temptation or appetite to scale more quickly to other African markets, I would just caution against that. I think one of the things we've seen is our companies that try to scale more quickly before they've really nailed product market fit and the sustaining profitable business in the home market, and underestimate the complexities of operating in different geographies. And I think in West Africa, that can be especially true, where moving between markets can feel like moving between planets. And so just would say, to caution against that temptation as it may relate to the free trade agreement.
Fantastic. Thank you so much. I do believe I've gotten prompted. I think we've hit our time limits for this session. So I would like to say a huge thank you to the panelists. I think just based on my glancing on the side discussions, people have found this session quite insightful. And I think that was the main aim for us today, to get people talking and understanding the alternative sources of finance that do exist out there. So once again, I would like to thank Leap Africa for giving us the opportunity to come and have this discussion again. I would like to thank each of the panelists for taking the time and for being so easy to understand for us that are new to your world. Thank you very much for your time today.
Thanks, everyone. Take care.
Thank you.
Yes. All right.
Thank you.
Bye. Bye-bye.